Have you ever wondered why the rich seem to keep getting richer while the poor struggle to break free from their economic shackles? United States tax code plays a crucial role in this economic inequality. Hi, and welcome to another video of tax series from Pars Financials. My name is Arash Shahriari, an IRS enrolled agent. My goal is to educate the public on our flawed tax laws. My hope is to run for office and use my knowledge to make large-scale changes to elevate the life standards of Americans. So let's delve into the basics of the U.S. tax code. At its core, the tax code is a collection of laws and regulations that dictate how individuals and businesses are taxed. It's a massive document with more than 70,000 pages filled to the brim with intricate details, exceptions, and loopholes. Then we have corporate taxes, which are a whole other ballgame. Companies are taxed on their profits, but the effective tax rate can vary significantly due to deductions, credits, and loopholes. Some corporations have even managed to pay zero taxes in certain years, despite reporting substantial profits. So, what's the upshot of all this complexity? The tax code can be a labyrinth for the average American, but a treasure map for those with the resources to navigate it. As we can see, the U.S. tax code is a complex beast, but how does it compare to other countries? Our first stop is Japan, a nation with one of the simplest tax codes in the world. It's a masterclass in clarity and conciseness. Unlike the United States, where the tax code is thousands of pages long, Japan's tax code is a mere few hundred. This simplicity is not just about reducing paperwork. It's about ensuring that everyone, from the wealthiest tycoon to the humblest laborer, knows exactly what they owe and why they owe it. Next, Sweden, a country known for its progressive tax system. The concept of progressivity is simple. Those who earn more pay more. But Sweden takes this a step further. They have a higher top marginal tax rate than the United States, and also a broader tax base. This means that a greater proportion of income is subject to taxation, and the wealthy are less able to exploit loopholes to reduce their tax burden. Next, Brazil. The Brazilian tax system is an example of how not to address inequality. Despite a high tax burden, the country struggles with severe income inequality. This is largely due to their regressive tax system, where the poor end up paying a higher proportion of their income in taxes than the rich. It's a stark contrast to Sweden's approach, and a clear illustration of how a poorly designed tax system can exacerbate inequality. Our last stop is New Zealand, a country that has taken a novel approach to taxing wealth. Instead of taxing income, New Zealand imposes a broad-based tax on consumption. This goods and services tax is applied equally to everyone, regardless of income. While this may seem regressive on the surface, New Zealand balances it out by providing generous social services funded by this tax. Each of these countries offers a different perspective on tax policy. Japan shows us that simplicity and transparency can make a tax system fairer and more understandable. Sweden demonstrates how a progressive tax system can help reduce inequality. Brazil serves as a cautionary tale of how a regressive tax system can contribute to inequality. And New Zealand provides an alternative approach to taxation, focusing on consumption rather than income. Comparison of these countries highlights the importance of thoughtful tax policy. A well-designed tax code can reduce inequality, fund essential services, and promote economic growth. A poorly designed one can do just the opposite. One of the most glaring issues is the presence of tax loopholes. These are provisions in the tax code that allow individuals or corporations to reduce their tax liabilities, often in ways that were not intended by the law. First is the carried interest loophole that allows investment fund managers to treat their income as long-term capital gains, which are taxed at a lower rate than ordinary income. This is despite the fact that this income is derived from managing other people's money, not from their own investments. Another loophole is the step-up in basis at death, which allows heirs to avoid paying capital gains taxes on the increased value of inherited assets. The third one is the big mess involving Social Security and Medicare tax. Social Security tax and Medicare taxes combined are 15.3%. When you work as an employee of a company, this tax gets divided in half between you and your employer. But when you are an independent contractor, you are responsible for both halves. In my opinion, corporations like Uber or Lyft avoid Social Security taxes altogether by classifying their employees as independent contractors, which allows them to put the entire tax burden on their workers. Not to mention, they also could dodge paying the separate unemployment tax, which, as an employee, your employer should pay on your behalf. The other issue with Social Security and Medicare tax is the cap limit of $168,000. Originally in 1940s, when the Social Security cap was presented to Congress, it was meant to stop the high earners above the limit to take advantage of Social Security retirement benefits so that only those who need the retirement money will get it and avoid the waste and abuse of public fund. But what Congress did was to change this entirely into the opposite. What Congress did was to relieve high earners from paying Social Security and Medicare above $168,000 of their income. Accordingly, corporations also do not need to pay their half of this tax on the high-earning employees' income above this threshold. Also keep in mind that a corporation entity does not pay Social Security and Medicare tax, unlike employees and independent contractors. Trump's administration tax cut reduced corporate tax rate to flat 21%, which is only applied after the entire set of deductions and allowances are deducted from gross profit of corporation, unlike employees who cannot deduct anything from their wages. The fifth issue is the charitable deductions and donor fund accounts. In my opinion, someone like Bill Gates, by creating his own charity, is able to donate his money to his very own charity and not pay tax on them. Some sections of the tax code allow the donated money over time to lose their charitable cause, and essentially can be withdrawn without tax all along, while the nonprofit charity, meanwhile, can engage in tax-free investment strategies and hence increasing the value of the donations. The preferential treatment of certain types of income also contributes to inequality. For example, long-term capital gains and dividends are taxed at a lower rate than ordinary income. This benefits the wealthy, who are more likely to have significant income from investments. On the other hand, wage earners, who make up the majority of the middle and lower classes, are taxed higher rates on their income. The impact of these tax code flaws is exacerbated by the lack of enforcement of tax laws. The Internal Revenue Service, IRS, which is responsible for enforcing tax laws, has seen its budget cut repeatedly over the past several decades. This has resulted in fewer audits, particularly of high-income individuals and corporations, who are more likely to engage in aggressive tax avoidance strategies. Without adequate enforcement, these entities can exploit the flaws in the tax code to reduce their tax liabilities, further contributing to inequality. These flaws create a system that seems to favor the wealthy, widening the economic gap. But are there solutions? There is always a way to improve, and the U.S. tax code is no exception. We'll consider three key areas: closing loopholes, increasing progressivity, and treating all income equally. Firstly, let's talk about loopholes. These are essentially provisions in the tax code that allow certain taxpayers to reduce their tax liability. While they may have been created with good intentions, they often end up benefiting the wealthy disproportionately. For example, the carried interest loophole allows certain types of fund managers to pay a lower tax rate on their income. By closing such loopholes, we can ensure that the tax code is applied more equitably. Next, we turn to the concept of progressivity. This refers to a tax system where the tax rate increases as the taxable amount increases. The idea is that those with higher incomes should bear a greater tax burden. But here's the catch. While the U.S. tax code is progressive on paper, in reality, the effective tax rate can sometimes be lower for the wealthy due to various deductions and credits. To make the tax code fairer, we could increase progressivity by raising the top marginal tax rates and reducing the availability of deductions and credits for high-income earners. Finally, we come to the principle of treating all income equally. At present, the U.S. tax code distinguishes between different types of income. For instance, wage income is taxed at a higher rate than capital gains, which are profits from the sale of assets. This disparity tends to favor the wealthy, who derive a significant portion of their income from capital gains. To rectify this, we could consider equalizing the tax rates for all types of income. But beyond these three strategies, there's also room for more radical reforms. Some economists argue for the introduction of a wealth tax, which would tax individuals based on their net worth rather than their income. This could potentially be a powerful tool for reducing wealth inequality. However, it's worth noting that such a tax would be a significant departure from the current system and would likely face considerable political and legal challenges. Another suggestion is the adoption of a universal basic income funded by tax revenues. This would provide everyone with a guaranteed minimum income, reducing poverty and potentially offsetting some of the regressive impacts of the tax system. Of course, no single reform will be a magic bullet for inequality. It will take a combination of measures implemented over time to make a significant difference. And any reform will need to strike a balance between equity and efficiency, ensuring that the tax system remains capable of raising sufficient revenue without unduly hampering economic growth. As we discuss these potential reforms, it's important to remember that tax policy is just one piece of the puzzle. Addressing inequality will also require broader changes to economic policy, including measures to promote job growth, increase wages, and improve access to education and health care. In conclusion, while the current U.S. tax code has its flaws, it also has the potential to be a powerful tool for reducing inequality. By closing loopholes, increasing progressivity, treating all income equally, and considering more radical reforms, we could transform the tax code into a force for economic justice, for reducing inequality rather than exacerbating it. Let me know in the comment what you think about the direction of the tax code.